put these on now? Or? Yeah.
Ron Siegel Radio, your home and mortgage connection.
You're listening to Ron Siegel's Home and Finance Radio Show, only on Financial News and Talk. Now live in studio, your host, local and national real estate expert and consumer advocate, Ron Siegel.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion, delivered by conflicting media reports. We connect the dots so you know the actions you can take, how your family or business can benefit from current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. A very focused show. We only chat about items that affect the roof over your head, your bank account, and anything I feel would benefit you. But before we get into our intriguing content today, please join me in welcoming our featured guest and repeat offender on Ron Siegel Radio. Welcome back, Cory Neubauer, Next Year Insurance. Welcome, buddy.
Thanks for having me.
Glad to have you with us. And let me remind you, if you ever have any more finance-related questions, I am the consumer advocate looking out for you, and you can reach out to me directly. 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls, I'm broadcasting.
Well, I do have a great team when it comes to developing a financing plan or plan to save you money. I personally work with you, even if you don't have any needs today. Save this number in your phone for future reference, 800-306-1990, 800-306-1990. And yes, of course, we are celebrating today National Juice Slush Day. You know, I saw that this morning, and Cory, I said the same thing you did, that maybe it's a slushy, but it says juice in there. I don't think there's any juice in slushy.
No, I think it should be Slurpee Day. Isn't that 7-Eleven?
That's 7-Eleven, June 11th, Slurpee Day. Okay, let's move along then. Let's see. Well, unless juice slush day, if we put a little vodka in there, that might work a little better. Just throwing that out there. Not that I'm an alcoholic or anything. And it is early in the morning as we broadcast live recording for the afternoon program. Let's move along. Let's see. Having beaten anorexia, National Chocolate Chip Day. Did they forget the word? Josh, did we forget cookie on there? I mean, it must have been something that we missed. Chocolate. That's what it says. Chocolate Chip Day. He got it right, as usual. Okay, and on a serious note, National Peace Officers Memorial Day. And, you know, as we get closer and closer to Memorial Day, celebrating peace officers, well, I think we should celebrate them every day. And we really appreciate the men and women that go out and put it all on the line for us. And it drives me crazy when I see some of these organizations that are bashing the police. I love our police officers and appreciate them and the work they do all day, every day to keep us safe and you know, keep control and keep us away from anarchy. So, National Peace Officers Memorial Day, we appreciate you. We should do a question of the day, Josh. How do I follow the Peace Officer Memorial Day with a question of the day, though? But I will. How many slices of pizza could you eat in a minute? You know, I'm a guy that deals in finance, so the answer to financial questions are almost always the same. Cory, I think you might agree with me. You're in finance world also.
Right.
It depends.
It depends, yes.
Right? I mean, if you go to Zito's, you know, you might have them cut smaller. If you go to Costco, you know, those pieces of pizza, those are massive. So
Depends the time of the day too, right? Have
Yeah.
you eaten yet?
exactly.
If I'm hungry, I could probably get 3 or 4 slices down pretty quick.
Absolutely. Yeah, I could not the Costco ones. I couldn't get the Costco. Those are big.
Those are substantial.
Yeah,
sure.
those. Although, you know, so it is funny because, you know, you wonder sometimes about Costco. So they have that slicer that they use for their pizzas, right? And it cuts one of those massive pizzas into 6 pieces. And frequently when I have people over at the house, those pieces are pretty large and we're always having something with it. It's never like you just have pizza. You might have some meatballs, or you might have wings, or you might have an antipasto or whatever. So last time I went to Costco, I said, can you double slice it? They said, oh, you want 18? I said, no, you normally do 6. I think double would be 12. But
that's the machine doing it, right? Have you seen the machine that now puts the sauce on it for them?
No, I haven't seen
automatically?
that.
Yeah. Well, with labor rates going up, they figured out how to automate a few things.
And I noticed that at the Costco by me, I don't know if it's at all of them, you can't even go up to the counter and order anymore.
Nope.
Right? You have to go to the kiosk and order and take your ticket up to the window. And
welcome to self-service, $20 an hour.
Yeah. Thanks, Governor.
Yeah.
We appreciate you, man. Let's move right along. The Dow Jones Industrial Average up 210 points. We'll tell you in a minute why. S&P 500 is up 40. The NASDAQ is up 151. Oil up 19 cents a barrel. And the 10-year Treasury down 7 basis points. 4.369 is the yield on the 10-year Treasury. Thankfully, glad that that's going down a bit because that'll have an impact at some point on mortgage rates going down as well. I did notice this morning, though, that there's a bit of a change going on. And I know it's probably not something that the administration wants to talk about a whole lot. But not only is there people coming in from Mexico, Mexico has now become our largest trading partner, passing China. So that's a new one right there. Mexico rose nearly 5% from 2022 to 2023 to more than $475 billion. China fell 20% to $427 billion. So better start learning how to speak Spanish. But what's going to happen as that comes on, because the biggest areas or the biggest importers from Mexico, Hewlett Packard and Dell, they're looking at TELUS building plans to build a manufacturing plant. General Motors is investing $1 billion over there. If former President Trump gets elected, though, what's going to happen with all that? It'll be easy to close the border, won't it? They'll just say, you know something? You saw what happened with China and all these tariffs, because even though the Biden administration doesn't want anybody to know it, he never took off the Trump tariffs. Even though he complained about it the entire time that Trump had them on, didn't take them off. And now we see, okay, so our imports from China dropping 20%. Now, what do you think Mexico will do if Trump comes in and starts putting tariffs on Mexico and their imports drop 20%? The cartels might have to go and kill a few more people. I shouldn't say that. My family laughs at me because there's not a way in the world they're getting me to go to Mexico, and they've tried every which way. I'm trying to figure out what is there to do. Are you a Mexico visitor?
Somewhat.
Okay.
My wife is in your camp.
Is in my camp.
Yeah.
So maybe if you're somewhat, you can answer this question that no one else has been able to answer me. What can you do in Mexico that I can't go to Hawaii and do? Nothing, right? So now
it's a perceived cheaper alternative.
Perceived cheaper, but if you're going to one of the resorts, you're still paying a boatload of money.
Perceived, that's why I
said perceived, right? So that's why I'm thinking next month might be a good time to go to Hawaii and not go to Mexico. So just throw that out there for you. I can't figure out a good reason. Again, Mexico's not on my hit list. There's 190 countries in the world. And if I say there's that one I don't want to go to, okay. It's to me, it is what it is, right? I mean,
it is.
That's the bottom line. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, we're going to talk about insurance. We're going to talk about insurance twice because there's some big news on insurance that we're going to chat about. We're going to learn a bit about insurance from Cory. Thinking about selling? You want an agent with these skills. We'll talk about that, how medical debt can impact your credit score, and more. Reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio, your home and mortgage connection.
Confused about the home buying process? Or curious how much you really know about buying a home?
Take the First Home IQ quiz to test your understanding of buying a home. Created by the nonprofit First Home IQ, this 5-minute quiz will give you a score, what you missed, and why. Take the quiz in 5 minutes at rsrlinks.com/FHIQ and find out what you need to know about buying your first home. That's rsrlinks.com/FHIQ.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Mortgage Minute today being brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990. And yes, they do have the Home Select product. I just did another scenario. 1.67 was the effective APR, 30-year loan. And we did show them they're going up to $2 million is the latest one that we did. It was a $2 million loan. Let's take a look. Every day at this time, OBMMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. They do not tell us points paid, points received, or the APR. What they do is they give us the number that you put into your mortgage calculator. Yes, go to ronismylender.com and you can get a mortgage calculator right there on the app that we give you for free. 30-year conforming loans yesterday locked down 7.005. 30-year jumbo loans locked up 7.173. FHA loans down, they're pretty flat, 6.781. USDA loans down a little bit, 6.737. That's the rural areas, generally no down payment. 30-year VA loans, best loan on the market. Thank you to all of our veterans. That one was pretty flat also, 6.581. If you want our market commentary, we do put that out, our thoughts for the day, rsrmarketminute.com, rsrmarketminute.com. We send that out as early as the data will allow. Let's see what's going on this morning. The S&P 500 is down 43 points as I speak, as we record right now. We're going to look at the, for some reason, my computer is not showing it to me, so I'll go back to the other screen. 10-year Treasury, right now, that one is at 4.362. That's down 8 basis points. Those are big moves. We don't usually see the 10-year Treasury move that big. I'll tell you why in just a second. Now it's down 9 basis points. Mortgage-backed securities, whoa, those are up 41 basis points. That means interest rates are getting significantly better. Why? Well, we're in one of those backward stages. I know a lot of things in our country right now are backward, but we're in a backward state. When things are bad, the markets do better. When things are good, the market does worse. So what does that mean? Well, retail sales came in, and retail sales for the month of April were flat, which was lower than the 0.4% increase that was expected. Additionally, last month's figure was revised slightly lower from 0.7 to 0.6. Take out autos and gas, sales actually fell 0.1%. The core retail sales, which goes into GDP, declined by 0.3%. Now, it used to be that 2 negative quarters of GDP meant that we were in a recession, but in the last couple of years, they've changed some of these guidelines. But we'll see what happens. Last month's strong 1.1% core reading was revised lower to 1%. The negative 0.3% monthly reading is the lowest since January and really coincides with what we've been saying. A lot of signs the consumer is coming under stress. Like you've maxed out your credit cards, your buy now, pay later, 43% delinquency. We can't afford to live, but the president tells us we've got a great economy. I'll go on. I don't want to get caught up on that one, right? Now, what happened also today? Well, we got the CPI report today. March Consumer Price Index report showed that overall inflation rose 0.3% for the month, which is cooler than estimates of 0.4%. Year-over-year inflation decreased from 3.5 to 3.4, in line with the expectations. Core rate, strips out food and energy, also increased by 0.3%, which was in line with estimates. Year-over-year core CPI declined from 3.8 to 3.6. But we need to look at the insides of these numbers, because that's what's really important, and that's what's driving the market right now, is what are the numbers really telling us? Well, the biggest part of the CPI is shelter costs. 45.4% of CPI is shelter. That would mean rent, owner's equivalent rent, lodging away from home. But the next biggest area that's impacting it is auto insurance. So we saw shelter went up by 0.4%. And we see that auto insurance went up 1.8% month over month. That's a 22.6% annual increase when you're looking at motor vehicle insurance. Now, let's do some math here, because we had a core. If we get rid of all the rounding issues, our core unemployment, our core CPI, 3.62%. Shelter weighted average was 2.51, and motor vehicle, again, weighted was 0.84. So when you add those up, everything else in the entire universe, other than the roof over your head and your auto insurance, had an inflation rate of 0.27%. What do you think the Federal Reserve can do to make that any better? Nothing. But they keep talking about that. So that's where we're waiting for. They say, well, we need the inflation numbers to go down. Well, do you think your housing is going to go down while they've got high interest rates? Do you think that motor vehicle insurance is going to go down because the Federal Reserve raises or lowers interest rates? It has no bearing on insurance costs. So just take a look and watch what's going on. You're hearing all of these things first on Ron Siegel Radio. When you listen to the news tonight, heaven forbid you listen to the news on broadcast news, because you're gonna get, well, after they finish all the Trump coverage, although the court is out today, so we might get real news. But the bottom line is you're gonna hear that inflation is cooling and retail sales are cooling, but they don't tell you why, and they don't tell you what's driving these things, and why don't we get lower interest rates? Well, the mortgage market right now is telling you interest rates should be coming down, and they are. So that's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call. 800-306-1990. 800-306-1990. Welcome to Ron Siegel Radio. Today we're discussing a critical topic for every homeowner and HOA member: rising insurance rates. With us is Cory Neubauer from Next Tier Insurance Services, a leader with 25 years in the industry, ready to unpack the complexities of insurance and how to stay prepared. I hope we can stay prepared. Stay tuned as we explore actionable strategies to protect your home and community. Welcome, Cory Neubauer. How are you?
I'm well. Thanks for having me again.
Glad you're here.
Yeah,
So
we're starting to make this a pattern.
yeah, well, you know something. It used to be that insurance was just boring,
Yeah.
right? I mean, you go and
It's
you
still-
buy a
yeah,
house.
It's still boring. It's just now painful.
Oh, well, I don't know. It's pretty interesting.
Yeah, it's interesting for sure.
Right. I mean, because it used to be that, you buy a house, you sell a house, you live in a house, you call your agent and get insurance and forget it. And you're, 20 years later, you might, if you're still in the same house, which most people are not, you might talk to your agent once or twice, and you just keep renewing every year after year after year. And it's kind of nice and easy. And then you come up and 72,000 homeowners are getting terminated
By
insurance.
State Farm. Yeah. Yeah.
So now you guys might actually be getting a lot more calls than you used to.
So yeah, we're definitely a lot more popular these days. So yeah,
I'm not sure I like that popularity.
well, no, it's not, and it's not all. It's hard to deliver good news when the market is where it's at. So with all the admitted carriers leaving California or reducing their risk, like State Farm and some of these other carriers, there's less and less carriers willing to write insurance in California.
So is it an issue that they're looking to reduce their portfolio, or that they can't get the rates commensurate with what the risk is?
Combination of both. So admitted carriers are regulated in California, are regulated by the Department of Insurance. So they can only raise their rates a certain percentage each year. And those rates that they're able to raise, 7% or so, are just not sufficient to keep up with inflation and everything you were talking about.
Right.
Today. So basically, if they can't charge enough premium to offset the costs of operation plus paying out the premiums, they're not going to write those policies. And that's what they've done.
Now, see, that's an interesting concept, because the vast majority of the population never thinks about that part of it. If they think, okay, well, the government can just tell the insurance company that they can't charge more money.
Right.
Which is true. They do that.
And they do that with the admitted market.
Okay.
So it's
So now you have to explain that to me, the admitted market.
So admitted market, basically there's two sides of the fence, right? The admitted market that is regulated by the Department of Insurance, and the non-admitted. So it's kind of it's a kind of crass analogy, but if you have good credit, you can go to the bank and get a loan at a reasonable rate. If you have bad credit, you might have to go to Vinny, the loan shark, in order to be able to to get a loan. It's the same thing with the insurance.
I didn't even realize they had
standpoint. So what you have is the admitted market is controlled by that. So you're going to have more regular rates. When you go to the non-admitted, they're not regulated by the state, by the Department of Insurance. So they can charge whatever they want, and that's why these homeowners are seeing, like, how can my rates go 5-10x of what it was the year before, because you're going from the admitted market, the regulated market, to the non-regulated market. So we were talking about
that's an interesting one, that you're allowed to even, because so many areas you're saying I'm not even allowed to go from one to the other, right? I mean, I'm not allowed, if I'm not, as a lender, if I don't have my license, I can't lend no matter what I say.
Right.
But in this area,
I mean, there's over 100 and almost 120 admitted carriers in California alone. But a lot of those aren't writing that insurance anymore because it's not profitable.
So would that be? I got a question here from Rich. He wants to know, why did my insurance go up over 100%?
Yeah, and that's why, because you probably went from admitted carrier like State Farm, Farmers, Allstate, to a non-admitted carrier, and so those non-admitted carriers are not regulated by the state of California, so they can charge whatever they want, and they're charging enough premium in order to stay profitable.
So let's explore that a little bit,
Yeah.
because you and I had a case that we were working on. And we looked at it, and initially we thought that they were going to be looking like a $3,000 premium, and then we found out, okay, there's 3 water claims, and it went to $15,000.
Right.
Is that because we had to go from admitted to non-admitted, or is it just because of the risk level?
More than likely, the admitted carriers have more stringent guidelines. Just as they're regulated by the state of California, they also want to make sure the risk that they're bringing on is less. So right, if you do have claims history, or you're in a wildfire area, or there's other attributes of the property that make it a higher risk, that's what's going to take them out of that admitted market, or the premium, getting that premium rate.
Okay, so when we come back, what I want to talk about a little bit is, maybe you can share with us, how do we
Get ahead of this?
Or how do we deal with, if we did go from admitted to non-admitted, is there something that we can do to kind of save a little bit of money? Maybe we'll talk about that when we come back.
Definitely.
You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. You can reach me anytime off air number 800-306-1990, 800-306-1990, or ronsiegelradio.com, facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Hey there, friends. Wondering if now is the right time to buy a home? Or are you waiting for a bunch of foreclosures? The facts speak loud and clear. Defaults and foreclosures are down. Sure, we might be headed towards a recession. But did you know interest rates typically drop and real estate values often go up during a recession? So what are you waiting for? Higher prices or higher payments? Don't navigate these waters alone. Connect with RonSiegelRadio.com today. That's RonSiegelRadio.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio, or anytime at 800-306-1990, 800-306-1990, the real-time real estate segment being brought to you by rsrmoney.com. rsrmoney.com. Thinking of selling? You want an agent with these skills. Selling your house is a big decision. Your home is one of the biggest investments you've probably ever made. And it's a place where you've created countless memories. That combo means there's going to be a lot of emotions involved. You want someone who understands your perspective, knows what it feels like, and is an expert at helping homeowners just like you navigate the process of selling a home. That's where a good listing agent, also known as seller's agent, comes in. Here are just a few skills you want your agent to have. The ability to turn something complex into something simple. Some agents are going to use big fancy real estate terms to try and impress you, but you shouldn't have to know all the industry jargon in order to understand what they're saying. If anything, it's an agent's job to keep it simple so you don't get overwhelmed or confused. A great agent is going to be someone who is very good at explaining what's happening in the housing market in a way that's easy to understand, but they'll take it one step further than that. They'll explain what's going on and specifically what that means for you. That way you're always in the loop, and it's a lot easier to feel confident when you're making a big decision. As Business Insiders explains, quote, maybe you have a better rapport with one of the agents you're considering, or you just feel like they're easier to approach. You're going to be working closely with this person, so it's important to choose an agent you're comfortable with, unquote. I'm going to share with you, don't just go to a friend, though, unless they're really good at what they do, especially in this market. I'll talk about that in a minute. A database approach on how to price your house, while it may be tempting to pick the agent who suggests the highest asking price for your house. I hate when people start talking about that idea. That strategy may cost you. It's easy to get caught up in the excitement when you see a bigger number, but overpricing your house can have consequences. It could mean your house will sit on the market longer because the higher price is actually turning away buyers. Instead, partner with an agent who's going to have an open conversation about how they recommend you should price your house. They won't throw out a number just to win your listing. A great agent will back up their number with solid data, explain their pricing strategy, and make sure you're both on the same page. NerdWallet explains it this way, quote, an agent who recommends the highest price isn't always the best choice. Choose an agent who backs up the recommendation with market knowledge, unquote. Fair but objective negotiator. The home selling process can be emotional, especially if you've been in your house for a long time, but that sentimental tie can make it harder to be objective during negotiations. That's where a trusted professional can really make a big difference. They're skilled negotiators who know how to stay calm under pressure. You can count on them to handle the back and forth and have your best interest at heart throughout the process. Not to mention, they'll be able to rely on their market expertise and what they're seeing work in other transactions to offer the best advice possible. Rocket Mortgage explains it this way, quote, whether this is your first or third time selling a house, listing agents work to help make the home selling process smoother and less stressful. Those real estate professionals know the ins and outs of the industry and can help you secure the best deal, unquote. And if you're hearing about not paying the buyer's agent, please drop it. That's a stupid idea. It's the dumbest thing anybody could ever do. Yes, that's my opinion, and I'm right. The idea here is if you want to get more people out there selling your property, showing your property, pay them. It's so stupid when I see these people that say, I'm not going to pay the buyer's agent, or I'm not going to do any of that. Well, that's a stupid. Again, I've talked to you about that before, where we've talked about, I recommend pay them more. rsrsalesmax.com, rsrsalesmax.com. See how to pay more so you get more people bidding on your house. If you get a bidding war, the price goes up. Price does never go down in a bidding war. Whether you're a first-time seller or you've been through this before, a great listing agent is the key to your success. Give me a call at 800-306-1990, 800-306-1990. So that's the real-time real estate segment brought to you by rsrmoney.com, rsrmoney.com. Continuing our conversation, Cory Neubauer is with us. Next Tier Insurance. He's out there on the daily basis dealing with all this insurance. Cory, now, are other states going through this crap in the insurance world as we are in California?
Yeah, definitely. So you have to remember, insurance companies are not just in one state.
Right.
So they're in multiple states. So Florida is obviously, a hot spot, just like California. And many
And
others.
no pun intended.
Yes.
Well, the reason I say that is because probably, it's going back 4 or 5 years now. I had the fire chief for Anaheim was on the broadcast with me, and we wouldn't talk about this on air, but off air, he and I discussed the fact that some of our environmental policies are causing the massive the brush fires that we have in California. Well, some of the other states don't follow some of these same policies that we do. My comment to him was, hey, we used to, when I was a kid, you'd hear them talking about controlled burns. And they said, well, that's bad for the environment. And I said, well, is a brush fire good for the environment or an out of control fire? And he said, well, that's just the way it is nowadays. And I don't know if the other states have that same policy as we do in California.
Well, I mean, California is we like our laws.
Yeah.
And
We like to control everything.
We like to control everything. So that's definitely in California. That's definitely impacted it, right? Because the solution now is to provide more, more helicopters, more engines, which is great. But we got to remember that the insurance companies are not following the fire code. Just be a lot of in kind of moving forward with that. It's
like we as lenders, there's a law that you have to follow, and the insurance companies follow the law.
Yeah.
But then they have an overlay that they have to put on it to be in business.
To be in business, right? And a lot of people think, hey, I've done the fire mitigation stuff. I've pulled my brush back, done all these other things, but the insurance companies aren't necessarily using the local fire code as a reason to rate the property. Because again, with fire, those embers can travel up to a half a mile when the winds. So it's a whole different thing. But in regards to overall, just the state of insurance nationally, everything is still going up. But we see it more in California and Florida, a lot more.
Who would have thought places like the Reagan Library have come up with the simplest solution to their fire problem?
Right.
They've got those 700, I think it's 700 goats out there.
Yep.
Cleaning up the underbrush.
There's some people that are now they're staging fire protection staff that are ready to respond.
Wow.
Because it's getting so bad.
So how would somebody know if they have an admitted or a not admitted insurance company?
Well, the admitted, you're going to recognize the name, right? These are the big companies that advertise.
Okay.
The Geicos, the Allstates, all the main brands that you see out within the market.
Now the odd ones that I keep coming across: Lemonade, I think, or Hot Chocolate, or Bamboo,
right? So
are those non-admitted?
Those some of those are admitted carriers. They're just they don't have as big of an appetite, but they are taking some of this risk lately. Because all the standard non-admitted carriers are not writing anymore. So, but it's not it's at a much higher rate.
So, what are some of the solutions that are out there? What are some of the? Rich just put in here that his rate went from 1,600 to 3,200.
That's pretty good.
Rich, that was good, buddy. Okay, so
no, I'm
it doesn't feel good.
I'm being facetious, but what we have to remember is that insurance throughout the years, like you said, you didn't think about it. It's been artificially low for many years. Think about it. You have $1 million property now, and you expect to pay $1,600. Think of it as a business. Like, how many properties does the insurance company have to insure at $1,600 to cover a loss of one property? So these rates have been artificially low for a long time. So there's two things that are going on: inflation, all these additional construction costs, everything to repair is that much more expensive. And now they need to bring those rates up so that they kind of match with today's market. And so it's kind of a perfect storm of all this stuff coming together that's causing that. And these insurance companies just are not bringing enough premium in to be able to remain profitable. And that's why a lot of them are leaving the state. And we know capitalism works.
Right.
When there's multiple options. When there's less options, what happens? Prices go up because there's not competition. So the solution, the hopeful solution, is that the different Department of Insurances let these admitted carriers raise their rates so that they can be competitive or profitable, and then they'll come back into the market. It's not going to go back down to $1,600, but you're going to have more admitted carriers that are willing to write that insurance, which will normalize the market. In the interim, with the client that you just mentioned, going with a higher deductible could be a potential way to mitigate some of that increase.
So we have to help with that part of it, because I've talked about that. Maybe you and I have talked about that in the past, as far as a higher deductible.
Yeah.
And the issue with higher deductibles is we don't save money in this country.
Yeah.
Right. For the most part, when you hear the statistics about how many people, if they had a $400 event on their car, they couldn't afford to get it done, or they had to put it on a credit card. So I know I've got two solutions for higher deductibles. Let's hear what you have to say.
Yeah, no, I get it. And in a normal market, that wouldn't be the case. But if you're looking at, like, your client, a double the increase, you're going to spend that money anyways.
Right.
So instead of giving it to the insurance company and waiting or anticipating a loss, you save that money, or you at least don't spend that money and maybe pay a little bit more when an actual claim happens. Most people are intoxicated by this low this low deductible, thinking that they're protected. But we were talking about car insurance, right? If you have a $500 deductible and you have a $700 accident, are you really going to file an insurance claim? Probably not.
Right.
So then why are you carrying insurance down to $500? Raise that up. It's the same thing with your house. If you have a $1,000 deductible and there's a $1,500 loss, are you going to file an insurance claim and impact your insurance rates for the next 3 years? Probably not. So why carry that lower deductible if you don't intend to use it? So each person needs to understand where they are financially, what they can accept. Personally, for me, I've raised my deductibles to $5,000 in my house. If something happens, I'm going to self-insure for that first $5,000, but that helps to keep my rates down, because at the end of the day, the insurance company is going to charge you more if you file claims. It's frustrating. You're like, I pay all this money,
Right.
and I should be covered, but let's not put our head in the sand and not know the reality of this is a business for them, and that's what they're going to do. It's just like your driving record. If you get a speeding ticket, your rates are going to go up. So it's the same thing. So it's managing your insurance, where before you just set it and forget it. Now you need to manage one more thing that you need to be aware of and not put your head in the sand. And when you do get that renewal, go out and shop. The problem is that there's not, everyone thinks, well, I can save 20% if I go somewhere else. The underwriting guidelines, which are the rules that they follow, are becoming more stringent, not less. So your house, it needs to be in good working order. Some of these companies are sending out drones to look at your property to see if there's stuff, if you're a pack rat or not.
Yeah, we've had some home inspectors that's a new product that they're selling now.
The other one I've seen is one of the admitted carriers said they're requiring their insured to walk through the house with their camera and record a video of the interior and exterior of their property to show the overall condition. Because before, it was always assumed that you kept your house in good working order, right? The roof was, current, the electrical, all that stuff. But now they're wanting you to prove it.
Yeah, makes sense. So we've got two different solutions that might help you in covering in dealing with the deductible. We're going to talk about that when we come back. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. You can reach me anytime off air number 800-306-1990. 800-306-1990 or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the numero 1 on YouTube. Stay tuned. We will be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
79% of all credit reports have errors that should be corrected through factual disputing. You could be saving thousands every year if your report was accurate. CreditSanitizer.com provides a free credit report audit when you furnish a specific $1 credit report. You can use this information to request corrections to your report and potentially save thousands of dollars. Get your free credit audit at CreditSanitizer.com. That's CreditSanitizer.com for a free credit report audit. CreditSanitizer.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Borrow Smart segment today being brought to you by rsrdebtfree.com, rsrdebtfree.com. If you have more debts than you can pay off in the next 60 days, rsrdebtfree.com. So let's tie in with what we've been talking to Cory Neubauer about today. So you're dealing with your insurance costs going up. And for many, many years, we've all been keeping our deductibles low. And we say, let the insurance company pay for it. And that's because we don't save money. So here's two smart solutions for you in the Borrow Smart segment. Number one, if you qualify, and again, talk to your tax people, go and get a Roth IRA and start putting some money into the Roth IRA. As your Roth IRA accounts build, you can then take and increase the deductible on your insurance. Now, I'm not giving you tax advice, but if you take the money out of your Roth IRA, the money that you put in comes out tax-free because you've already paid taxes on it. Your earnings you have to pay taxes on. But you can take the money out. Again, talk to your CPA. Second solution, we've been talking about this a lot lately, rsrhomeselect.com, rsrhomeselect.com. You can actually be using the equity in your property to pay that higher insurance deductible. So Cory spoke a little bit ago about the $5,000 deductible. How do you afford it? Well, if you've got this loan, you're paying down your house, your 30-year loan will probably be paid off in 6 or 7 years with a low interest rate. You're actually saving money in that to pay the higher deductible. When you get a higher deductible, your premium goes down. That's a Borrow Smart segment brought to you by rsrdebtfree.com, rsrdebtfree.com. Continuing our conversation, Cory Neubauer, Next Tier Insurance, is with us, chatting about everything we didn't plan on today, Cory.
Yes, I know. What were we going to talk about anyways?
We're going to talk about some of these HOAs where we can't get insurance.
Yes. So yeah, we specialize in HOA insurance. So, but yeah, that's becoming, just the individual homeowner is seeing those double increases. These HOAs, they have a master policy that is covering the structures, and those are skyrocketing.
So I wanted to find this out, so I'm sure other people want to know the answer too. You go to a community, a condo community, and we were talking about, I think Coda de Casa has gone in their condos where they're now no longer covering the insurance as far as the HOA.
The structures.
The structure.
Yeah.
And the insurance company is saying, we don't want it either. So people have to go to the fair plan. Now, if you've got a common wall with somebody, who's responsible for that fire?
That's a good
the
question.
Judge.
That's a good question. It does definitely get complex because the initial thing of an HOA in the community was that you're in a common development,
right?
That you're all pulling together, and this is now spreading that apart. So it hasn't really been tested. In that sense, that's going from an individual unit owner policy to more like a homeowner's policy.
Right.
But yeah, you do have common walls because what happens if your neighbor doesn't buy insurance? Now you got your house rebuilt minus the interior wall of your neighbor. So yeah, it is challenging. And the fair plan has always been the plan of last resort.
Right.
And that fair plan is now growing exponentially in size, which is not necessarily a good thing because, again, it's if you want something done well, you let the government do it, right?
Well, I did hear that we're 16 years into the Governor Newsom's 10-year plan for homelessness in San Francisco.
Don't get me started on that.
So, yeah, you're right. I mean, the government's always got the best answer.
So really, the path that should be is you should go to the admitted carriers. If you can't get coverage there, you go to the non-admitted, and then you go to the fair plan. The intoxicating thing has been that the fair plan has been a little lower in price. So people are going to the fair plan, skipping the excess and surplus or that non-admitted market.
So do you guys handle all of those?
We do.
Okay,
we
so
do.
If you need help with all of that, you just call Cory and let him deal with it.
And that's where you're saying in your pitch there with having a trusted partner, right? This is very complex. It's not simple. You don't have to know all the details. It's get to the right people and let them show you the way, because it is, and it's continually changing. I mean, from 30 days ago, things are dramatically different. So yeah, it is. But with regards, circling back to the fair plan, it's supposed to be the resort, the last resort. And it's kind of like with health insurance. How long do you want to be on COBRA?
Right.
For as short as possible.
Absolutely.
And now that's being used as a solution. The problem with the fair plan is it's not a full encompassing policy. It only covers fire. So it's not a full policy. So you have to get another policy, a companion policy to cover the other losses. So
are admitted companies covering the other policy, or are they away from that also?
They're few and far between. If you're in the area of last resort. So you're seeing these cancellations left and right. So it's a challenging market for sure.
So here's the issue that I see, especially as a consumer advocate, as I look at it. 25 or 30 years ago, I went and got an insurance license. I needed it for Merrill Lynch.
Right.
And when I went to get the license and sit for the classes, the lady said, you guys that are here from broker dealers, we don't want to hear from you because all we care about is getting the right answers to get the test completed. And you guys try to think about this stuff too much.
Right.
So you got a lot of people that went through those classes, got insurance licenses it was really simple then. And now you're really having to be a expert at your craft.
A surgeon. Yeah.
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 And so if you're looking at people that may do this just on the short come on the as a side gig, they may not be able to get you the answers you really need.
Well, it's definitely like for us, right? We focus on HOA, so everyone has their niche. So working with people that understand that is most important. So on the homeowner side, we understand it. We have good referral partners. It's a matter of having access, because every day, just like the interest rates are changing, the carriers that are covering these things are changing, minute by minute.
Rich, I'm going to have to send you a cocktail here, because I see, so he's dealing with the HOA as well, going from 410 years ago to 840 now, 580 to 840 in 3 years. So
and
you're
that's
getting all of them, Rich.
Yep, Rich, I feel your pain. We have that with so many clients. We have one right now that we're quoting it. Last year it was 100,000 and now it's 300,000. We have one
for an association,
for the whole home. But right, you have to multiply,
which then trickles down to
who's
every individual
who's going to
member
pay for it. So that goes back to the Department of Insurance as well. If they're going to regulate those carriers, the admitted carriers, they also insure the HOAs. So all those HOAs are having to go to non-admitted, and who's going to pay the premium? Ultimately, the individual homeowner through their HOA dues, or they have to get
or a
loans
special assessment or something.
with the special. I mean, Coda de Costa, we had a client that it was $7,000 per unit owner for 1 year of insurance. So it's different if you get a special assessment and you get a new roof out of it,
right?
But 1 year's of
1 year
insurance
lifespan.
premium, yeah, so it's getting progressively worse. So the HOAs are going to higher deductibles, but then and less coverage, right? They're not getting the full coverage for the property, which turns into
which
lending
then becomes
issue.
a lending issues because we want to have full coverage if we're gonna, as the lenders are gonna say, hey, something, we want our collateral to be covered, to be protected.
And those FHA and Fannie Freddie requirements are very cut and dry. But it's they're having to modify those, or at least look at different options in order to keep loans going.
Which goes back to the same thing: is if you want someone to do it right, are you going to call the government?
Yes.
So, and something, as a leading a lending team, I say the same thing: is we do have the non-traditional lending sources. They're out there saying on a case-by-case basis, we'll look at it, but they want to know, because I think most of them realize that if you're in the middle of downtown Anaheim and you were canceled by State Farm, you're probably not in a high fire risk area, right? I mean, if you're in Anaheim Hills, maybe you are. Maybe in Chino Hills, you are. Go to Casa, you might be.
Yeah.
Right. But if you're on the coast of Newport Beach, you're probably not in a high fire risk.
But the fire risk has been the big hot topic for the past couple of years. But the insurance companies have already baked that in now.
Have they? Okay.
The next thing that they're working on now is aging communities. So you said Anaheim. How old is Anaheim?
I think 1867 or
but
something.
Even even South Orange County, all these developments, the insurance companies, after 30 years, they expect things to be improved or replaced.
Sure.
That means,
and we don't have any money right now.
That means electrical
We're
wiring.
broke.
Yeah, electrical wiring, roofing, balconies, all those things. So that's the next thing that they're looking at, and that's why the rates are going up as well, is the aging communities. Have you ever heard of a Zinsco panel, which is an electrical panel that a lot, and especially in California, was used, and it's on recall. It can potentially start a fire.
Wow.
So if you have those Zinsco panels in your community, your rates, you're not going to be eligible for admitted carrier anymore. So they're going to push you to the excess and surplus. So it's some of the existing attributes of your community that will make you less insurable. Not that you have claims, not where you're physically located, but the age of your community. So all these things are coming into play. And again, we talked about that perfect storm. It's all coming together because the insurance companies are realizing this is where we're losing money. So they're stopping the gap. They're filling.
Well, that might help some of the other people then.
Yes.
And again, if you have if you're taking proactive actions, I was with somebody the other day and I had heard from one of the other insurance companies also is they have these fire alarm or water alarms.
Yep.
Right. And if you have the water alarm, I think you get a discount on your insurance policy.
So it's a water shutoff valve.
Right.
Yeah. So if it sees that there's a large flow, like a bathroom, like a toilet back or flowing, it'll shut it off.
Right.
And again, some of those are going to, you can get a better rate if you put those into. Now we're requiring those in order to get a renewal. So there's tightening up their underwriting guidelines overall.
And I think from what I was just told yesterday, I think those are like $1,500 to $2,000. If you can save some money on your insurance, it might be worthwhile.
Definitely.
Great information. I appreciate you coming in and sharing with us, and we'll have to have you come back and talk about some of the things we planned on talking about.
Thanks for having me.
As always, we ask, set that first radio preset button to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. Big thanks to Josh and Sean who are engineering us today. And of course, a special thanks to you for spending a little bit of your day with us That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime. 800-306-1990, 800-306-1990, or ronsiegelradio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.